As of the close of trading on Friday, July 31, 2026, the stock market is officially closed for the weekend, and Super Microcomputer Inc., trading under ticker SMCI, finished the session at $27.73, locking in a substantial daily gain of 7.90% on heavy volume of 38 million shares. While surface-level headlines attributed this recent push to a surprising jump in projected gross margins, the reality beneath the tape reveals a far more complex dynamic unfolding across Wall Street desks. While retail traders across popular platforms celebrate what looks like a classic margin recovery story, institutional block orders and dark pool flow data paint a picture of defensive hedging ahead of an extraordinarily volatile upcoming event. The options market is currently pricing in an enormous 18% price swing following their impending fiscal fourth quarter earnings release on August 11th, signaling that big institutional accounts view the current valuation less as an unmissable bargain and more as a high-stakes binary outcome. If you follow mainstream market commentary or scroll through popular online investing forums, the dominant narrative surrounding Super Microcomputer is fairly simple. The story goes that after getting beaten down over 50% from its former peaks, the stock has become ridiculously cheap, trading at single-digit forward earnings multiples while sitting right at the heart of the global artificial intelligence infrastructure expansion. Many retail traders opening up their Robinhood app or browsing through retail investing sites see a high-beta enterprise server company riding the coattails of NVIDIA stock and figure that a rebound back toward $40 or $50 is almost inevitable. On paper, that logic sounds completely reasonable. When a tech business reports that new orders during a single quarter topped $60 billion and pushed its total backlog to record heights, it is easy to assume the bottom is firmly in place. However, when you pull back the curtain and look at how professional capital managers view this asset, a much sharper contrast emerges. The reality is that Wall Street is not treating Super Microcomputer like a classic value opportunity or a straightforward growth play. Instead, major institutions managing funds on interactive brokers and within complex Fidelity wealth management portfolios are evaluating it as a business burdened by severe execution risks, capital dilution, and lingering trust issues. While retail momentum buyers saw the jump in preliminary gross margins from 8% up to 17% as a massive win, institutional analysts immediately noticed that revenue is tracking near the bottom edge of previous guidance. In simple terms, top-line growth is slowing down faster than expected, and margin expansion driven by product mix in one single quarter does not automatically translate into long-term cash generation. To understand why the stock has been swinging so violently between $23 and $32 over the last several trading weeks, you have to dissect recent trading patterns and order flow. During the mid-July sessions, SMCI experienced massive single-day surges, including a massive 20% spike on over 160 million shares of trading volume. That kind of extreme volume does not happen because individual investors are buying small lots on SoFi Active Investing or through a self-investing account. That is the footprint of massive short covering combined with programmatic momentum trading. When a stock carries a heavy short interest, any positive preliminary news snippet causes a sharp squeeze, forcing short sellers to buy back shares aggressively. But notice what happened immediately after those volume spikes. Institutional sellers stepped in right around the $31 mark, capping gains and pushing price action back toward lower technical support levels. Recent macroeconomic headwinds and sector-wide capital expenditure debates are playing a massive role here as well. Big cloud service providers and enterprise hyperscalers are scrutinizing their capital deployment strategies far more rigorously than they did 2 years ago. While mega-cap tech giants continue spending billions on hardware, the market is beginning to question how quickly those investments will generate actual returns. That skepticism directly hits server server assembly specialists who operate with paper-thin baseline margins. When an investor compares SMCI to foundational technology holdings like Apple stock or Tesla stock, the structural differences in pricing power become glaringly obvious. Apple stock commands pristine pricing leverage and sticky software ecosystems, whereas server providers operate in a hyper-competitive, low-moat hardware layer where customer concentration can turn from a blessing into a burden overnight. Furthermore, balance sheet mechanics have created a heavy cloud over the stock that many casual investors overlook when conducting self-investing research. To fund its massive component purchases and handle working capital demands for liquid cooling server racks, the company completed a massive $7 billion equity and equity-linked financing deal in recent months. A capital raise of that magnitude introduces substantial share dilution, which means even if total enterprise value recovers, profit per share gets sliced across a much larger share count. When folks check their Robinhood stock trading interface or execute an online investment through Interactive Brokers stock trading, they often see a low price-to-earnings ratio and assume it automatically equals safety. But seasoned analysts using professional tools like Interactive Brokers platform or managing Fidelity ETFs understand that low multiples frequently reflect structural risk rather than mispriced value. Comment below how many shares of Supermicrocomputer you currently hold in your portfolio and what price target you are personally targeting before the end of the year. To fully grasp where this business stands today, it helps to step back and review what Supermicrocomputer actually does and how its core operational framework functions. At its heart, the company designs, builds, and deploys high-performance server solutions, enterprise storage systems, and specialized data center infrastructure. Rather than selling off-the-shelf standardized hardware, they specialize in modular server architecture, allowing enterprise clients to build customized compute setups tailored specifically for heavy workloads, edge computing, and artificial intelligence clusters. Their ability to quickly integrate new processor architectures from partners like NVIDIA stock has historically allowed them to get system solutions to market faster than traditional enterprise rivals. Over recent years, they've also placed a heavy strategic emphasis on direct liquid cooling technologies, which help data centers manage the extreme thermal output and power consumption generated by modern high-density processing racks. Looking back at past performance, the company spent years operating as a steady, somewhat under-the-radar enterprise hardware maker with moderate growth and predictable margins. However, when demand for high-density hardware exploded almost overnight, their speed-to-market model positioned them to capture huge market share gains almost instantly. That operational sprint caused revenues to scale at unprecedented speed, propelling the business into major market benchmarks and drawing immense attention from traders using every major brokerage, from Schwab Intelligent Portfolios to SoFi Invest and Fidelity Mutual Funds. Yet rapid expansion brought severe growing pains. Past administrative delays, internal control overhauls, regulatory inquiries, and board-level restructuring left deep institutional scars. When a company experiences governance disruptions or accounting reviews, big asset managers operating Fidelity Wealth Management accounts or structured intelligent portfolio products automatically apply a governance discount to the stock price. As we look toward the immediate future, the setup for Supermicrocomputer is defined by a tense balance between powerful operational catalysts and persistent structural risks. The main short-term catalyst is obviously the upcoming fiscal fourth quarter report scheduled for August 11th. Wall Street expectations are currently set at $11.55 billion in revenue and roughly 92 cents in per-share earnings. Because management already teased gross margins coming in between 15 and 17%, the market will not be satisfied with just meeting those figures. Analysts will be dissecting cash flow statements, net operating margins, and management commentary regarding component supply availability and customer payment terms. If cash flow from operations remains constrained despite huge top-line backlog figures, institutional trust will take another hit. Another vital factor to monitor over the coming quarters is customer concentration risk. A significant portion of current revenue and backlog is tied to a small group of massive technology clients. If any major hyperscaler decides to diversify their hardware suppliers or build custom server rack assemblies in-house, Supermicro could see order volumes shift rapidly. Additionally, competitive pressure from larger, well-capitalized enterprise competitors is intensifying. Competitors with massive corporate balance sheets can afford to price server chassis at near zero profit margins simply to capture long-term maintenance and software service contracts, putting continuous pressure on SMCI's long-term profitability goals. In summarizing the current landscape, the gap between market expectations and operational reality remains wide open. The prevailing expectation among casual retail traders is that Supermicro is an overlooked bargain bound to bounce back rapidly as hardware demand climbs. The reality, however, is that Wall Street views the stock as a complex, high-beta trading vehicle where top-line scale is being offset by heavy share dilution, tight